All right. It is Tuesday, February 10th, 2026. And today we are looking at a company that is, well, it's basically the operating system of the financial world.
That's a really good way to put it.
I mean, you see their name absolutely everywhere, right? Every time you check your 401k, every time you hear about the stock market on the news.
Or every time a country's credit rating gets a downgrade.
Exactly. We are talking about S&P Global. They just dropped their full year 2025 results. And honestly, this document it's a monster.
It's a dense one, but it's one of those reports that, tells you more about the global economy than it does about just the one company.
Right, because they have their fingers in everything. But before we get into all that, let's just set the stage. S&P Global, most people just think S&P 500.
A list of stocks.
Yeah, list of stocks. But looking at this report, calling them a list maker feels like, I don't know, calling Amazon a bookstore.
That's a fair comparison. They've really positioned themselves as an information infrastructure company. They actually unveiled a new mission statement in this report.
Oh, yeah.
Advancing essential intelligence.
Essential intelligence. That sounds a little bit like corporate marketing fluff, doesn't it? I mean, who decides what's essential?
It does sound like marketing, but when you really look at their business lines, ratings, benchmarks, analytics, it's actually pretty literal.
How so?
Well, if you're a bank or an investor or a government, you really can't function without their data. It's essential plumbing. If S&P just shut down tomorrow, the markets would freeze.
Okay, so the plumber had a good year. Let's get to the scoreboard. For the full year 2025, they brought in $15.336 billion in revenue.
Which is up 8% from 2024.
And just in the fourth quarter alone, they did nearly $4 billion.
The revenue growth is solid for sure, but if you want to understand the real story of 2025, you have to look at the bottom line. Adjusted diluted earnings per share was $17.83.
And that's up how much?
That's up 14%.
Yeah, hold on. So sales went up 8%, but profit went up 14%. How does that math work? Are they just, firing people?
It's not just about cutting costs, though we'll get to that. It's mostly about something called operating leverage. Think about it. Once S&P builds the software to rate a bond or track an index, selling that data to one more customer costs them basically nothing. So as revenue grows, a huge chunk of that extra money just drops straight to the profit line.
I see. So they're just getting more efficient at turning $1 of sales into profit.
Exactly. High fixed cost to build the machine, very low variable cost to run it.
Okay, that makes sense. But let's look under the hood. The biggest engine in this whole machine has to be the ratings business. This is where companies pay S&P to grade their bet.
Correct. And this division had a monster quarter. Ratings revenue jumped 12% in Q4.
12% growth for a business that's, what, over a century old? That's really surprising. Is it just because the economy is booming and everyone's borrowing money?
It's a little more nuanced than just the economy is good. It's actually being driven by a very specific structural thing happening in the debt markets. They call it the maturity wall.
The maturity wall. That sounds ominous. Like something out of Game of Thrones. What are we talking about here?
It's a legacy of the past, really. Think back to 2020 and 2021. Interest rates were at rock bottom. I mean, practically zero.
Right. Free money.
And companies loaded up on all that cheap debt. They issued 3-year bonds, 5-year bonds, just tons and tons of cash. Well, bonds have an expiration date.
And that expiration date is hitting now.
Exactly. All that cheap debt is maturing. The companies have to pay back the principal, but most of them don't have billions in cash just sitting around. So what do?
They borrow new money to pay off the old money. Refinancing.
That's it. And the S&P report explicitly says the 3-year cumulative maturity wall has grown 9% from the prior year.
So there's a literal wall of debt coming due that has to be refinanced. And you can't really refinance without getting a credit rating.
Precisely. You want to issue a new bond. You need S&P to grade it.
Yeah.
So S&P is just sitting there watching this wall of debt come closer and closer, knowing every single dollar of it is a potential fee.
But wait, interest rates today in 2026 are way higher than they were in 2021. Wouldn't that stop companies from borrowing?
Normally you'd think so.
Yeah.
But they have to refinance. They don't have a choice. The old debt is coming due. But there's another factor helping S&P right now.
Okay.
The report mentions that spreads across fixed income finished the year below historical averages.
Spreads. Okay, break that down for us. We hear this term on financial TV all the time. Why does a low spread matter so much?
The spread is, it's basically the risk premium. It's the extra interest a company has to pay above the safe government rate.
So on top of a treasury bond or something?
Exactly. And when spreads are low, it means investors aren't that scared. They're willing to lend money to corporations for very little extra cost.
So it's a borrower's market in a way.
It is. Even though base rates might be higher than a few years ago, that extra cost, the spread is low. And that encourages companies to say, hey, let's go issue this debt now while the market is friendly. That drove a 28% increase in what they call billed issuance.
Billed issuance. That sounds like the cash register ringing.
It is. That's the fee they charge right up front when the bond is sold.
Yeah.
And a 28% jump is, well, it's massive. It tells you the credit markets are wide open for business.
Wow. Okay, so the ratings business is printing money because of this giant debt refinancing cycle. Let's move to the other side of the house. The indices, the S&P 500, the Dow, all that.
Also a very strong performer. Revenue is up 14% in Q4.
This business model always fascinates me because it feels like a toll booth on a highway that just keeps getting wider.
It's the asset-linked fees model.
Right. You buy an ETF, S&P gets a cut. You don't buy an ETF, but the market value goes up, S&P still gets a bigger cut.
Exactly. As more and more money flows into passive investing, people just buying the whole index instead of picking stocks, S&P's asset base grows.
Yeah.
And if the market rises, their fee rises with it.
It's the ultimate work smarter, not harder business. But I did notice something in this section of the report that felt a little out of place. They're talking about blockchain.
Yep. This is their digital asset strategy.
I saw a line item for S&P 500 index on-chain. Now, usually when a legacy company talks about on-chain, my assumption is they're just trying to sound cool for investors. Is there actually something real here?
No, this is actually solving a pretty specific problem in the crypto world. Think about DeFi, decentralized finance. You've got these automated programs, these smart contracts that trigger trades or loans based on market data.
Okay.
But a blockchain is a closed loop. It has no idea what the price of Apple stock is. It doesn't know where the S&P 500 closed yesterday.
It's blind to the outside world.
It's blind. It needs an oracle, a trusted source of truth to feed it that data.
Right.
By putting the S&P 500 on-chain with partners like Centrifuge and Chainlink, S&P is positioning itself to be that source of truth.
So if I have some kind of robot trader on the blockchain that needs to balance a portfolio, it calls up S&P's on-chain data feed.
Right, and S&P charges for that data feed. They're basically building the plumbing for the next generation of markets, just like they already own the plumbing for the current one.
That actually makes a lot of sense. It's not about buying Bitcoin. It's about selling the data to the people who are. Okay, let's talk strategy. Because reading this, it feels like they're trying to shift their identity. They've got the public markets on lock, but they are spending a lot of money to get into private markets.
That is the single biggest strategic shift in this whole report.
Yeah.
Public markets, stocks and bonds, they're transparent. Data are relatively easy to find. But private markets, private equity, private credit, hedge funds, that's a black box.
And that's where the growth is, right? Because public markets are kind of saturated.
They are. If you want to grow, you need to go where the data is messy and hard to get. So S&P bought a company called With Intelligence for $1.8 billion.
And they just closed that deal in November of 2025.
Correct.
So $1.8 billion is a hefty price tag. But the thing that really stood out to me wasn't the price. It was their claim about the integration. They said they linked over 75% of the combined data sets in just 25 days. I have to be skeptical here. I've worked in corporate jobs where IT can't link 2 spreadsheets in 25 days. Is this for real?
It's a shocking number. I mean, usually integrating private market data is an absolute nightmare. You're dealing with PDFs, random emails, non-standard company names.
Yeah.
Just mapping Company A LLC in one database to Company A Inc. in another database usually takes teams of humans months of manual work.
So how did they do 75% in less than a month?
This is where their big investment in AI really comes into play. They claim they're using their own AI stack to ingest and map these entities automatically. And look, if that 75% number is real, and they put it in the legal earnings report, so it basically validates their entire tech strategy.
That's the competitive advantage right there. If you can buy messy data companies and clean them up almost instantly,
you win the platform more.
Yeah.
And it lets them cross-sell immediately. The report says they generated 200 new sales leads in the first 60 days. They didn't have to wait a year to figure out the synergy. They started selling right away.
You mentioned AI cleaning up the data. Let's dig into the AI section of the report more broadly. Because every company says we use AI, but S&P is talking about an enterprise data office and cutting run rate expenses. What does that actually mean?
Run rate expenses are your ongoing recurring costs just to keep the lights on. S&P has set a huge goal to reduce these specific expenses by more than 20% by 2027.
20% is a huge cut. Are they just unplugging servers?
Some of it is eliminating what they call app bloat, so they cut more than 10% of the applications they use. But the bigger play is automation. If you have thousands of analysts whose job is to read an earnings report and then type numbers into a database, that is really expensive.
Right.
If an AI agent can read the report and type the number, you save a fortune.
So the AI is the new junior analyst.
In many ways, yeah. And they're selling that capability to clients, too. They launched something called Capital IQ Pro Document Intelligence 2.0 and AI agents on Microsoft Copilot.
Oh, that's interesting. The agent on Copilot, I can see the appeal. Hey, Copilot, find every company in the S&P 500 that mentions supply chain risk on their last earnings call.
That's exactly what it does. It saves a banker hours and hours of tedious searching. And S&P, of course, charges a premium for that convenience.
So we have this company that is booming in ratings, dominating indices, buying its way into private markets, and automating everything with AI. It sounds like a perfect, well-oiled machine. But then there's this one jagged edge in the report. The mobility division.
The car business.
Yeah. S&P owns this massive automotive data business. They track car sales, manufacturing, dealership inventory, and in this report, they confirmed they're getting rid of it.
They're spinning it off. It'll be a separate public company in mid-2026.
Why? I mean, the division grew revenue 8% in Q4. It's not like it's losing money. Why chop off a limb that's perfectly healthy?
It all comes down to focus and valuation. Think about it from an investor's point of view. If you buy S&P Global stock, you want a high-margin, asset-light financial data business. You don't necessarily want exposure to the messy, cyclical world of automotive supply chains.
It just muddies the water.
Exactly. It's what Wall Street calls the conglomerate discount, the theory that the parts are worth less together than they are separately. By spinning it off, S&P becomes a pure-play financial intelligence firm.
And the new Mobility Co. can just focus on cars.
Right, without fighting for budget against the S&P 500 team.
So by the end of this year, S&P is going to look very different. No cars, much deeper in private equity, and running on AI.
That's the transformation in a nutshell.
Okay, so let's look forward. What's the guidance? What are they telling us to expect for the rest of 2026?
They're projecting organic revenue growth of 6% to 8%.
Which is pretty consistent with what we've seen.
And they're targeting earnings per share of $19.40 to $19 per cent ounce a number. They are knocking on the door of $20 per share in pure profit.
That's a lot of cash to be throwing off. And speaking of cash, I have to mention the dividend.
Yes, the streak continues. 53 consecutive years of dividend increases.
53 years. That is just insane consistency. That means they raised the dividend through the dot-com crash, the 2008 financial crisis, the pandemic. Nothing stopped that check from going out.
It puts them in this very elite club of dividend kings. And their plan is to return 85% of their free cash flow to shareholders. Basically, if they don't need the cash to buy a company like With Intelligence, they're giving it right back to you.
Okay, I've been pretty positive so far, but I have to be the skeptical friend here. What breaks this machine? I'm looking at the safe harbor statement in the back, which is usually just legal jargon, but were there any real red flags in there for you?
There was one very specific, very modern risk that really caught my eye. They listed AI-driven power demand fluctuations under their commodity markets risks.
Wait, what? S&P is worried about the electric bill.
They're worried about the volatility caused by AI. We all know these AI data centers are sucking up massive amounts of power. S&P is basically saying this demand could get so high and be so unpredictable that it actually destabilizes energy markets.
And since S&P owns the benchmarks for energy markets,
If those markets go haywire, it becomes harder to forecast, harder to rate utility companies, and it creates what they call geoeconomic risk. It's this fascinating feedback loop where their own strategy pushing AI contributes to a macro risk that they themselves have to monitor.
that is wild. The AI they use to solve problems creates a power problem that changes the very markets they're trying to measure.
Exactly. They also mentioned the standard risks, of course. Regulatory crackdowns, or what happens if that maturity wall of refinancing stops because interest rates suddenly spike again.
Let's pull all this back and just summarize this deep dive. We're looking at February 2026. S&P Global is capitalizing on a massive wave of corporate debt refinancing. They are, in effect, taxing the passive investment boom. They are aggressively buying up private market data and using AI to integrate it at lightning speed. And they're shedding their auto business to become a pure financial services company.
That's the picture. It's a company that is aggressively modernizing while still profiting from, one of the oldest tricks in the book. lending money.
And that actually brings me to my final thought for you, the listener. I want to go back to that maturity wall.
The 9% growth in debt that's coming due.
Right. S&P Global is essentially betting its future growth on the fact that the world is drowning in debt and has to refinance it. They're the toll collector on the highway of debt. For them, that wall of maturing bonds is a massive business opportunity, but for the global economy, if we've reached a point where we must refinance trillions of dollars just to stay alive, and we're relying on one company to grade all that paper, how stable is that foundation, really?
That's the big question. S&P measures the risk, but the rest of us have to live with it.
Something to think about next time you see that S&P 500 ticker scroll across your screen. Thanks for diving deep with us.
Thanks for listening.